Believe it or not, today, the S&P is down over 1%, and you generally have a risk-off market today. But in fact, you had better than expected industrial production numbers and better than expected real estate data. You're seeing bonds that are up today. TLT is up 0.38% after being red in the beginning of the trading day today. What's happening, my friends, is the markets are preparing for Jerome Powell coming tomorrow. Jerome Powell's really the biggest catalyst for markets, period. There's like nothing bigger than the Fed, especially in the last, couple of years, but right now, it's critical. So yes, we have a lot to go over here in this video of news on the day today, sentiment, positioning, what's going on with markets, the data. There's peace talks about Ukraine again, but all of that is secondary to what we're going to discuss first, and that is Jerome Powell's conference tomorrow and the summary of economic projections. And I'll give you the silver lining. The best case scenario, if you will, is nothing changes. Nothing changes. The Fed's on pause until they see better data. They're not concerned about a recession. They're not really thinking about raising rates at this time. That's your best case scenario. Now, what's going to make the markets move tomorrow, up or down, is anything new. If Powell were to theoretically, let's say, come out and talk about a recession, that they may need to cut rates more than they expect this year because the economy's weakening, well, you can make an argument that that would be negative for markets, at least initially, would be good for bonds, and potentially, once we kind of factor in what more rate cuts could look like, could inevitably be a positive for markets. Markets tend to like rate cuts. Or if Powell comes out tomorrow and they're thinking maybe they're going to cut rates less than twice this year. Maybe they're not going to cut rates at all this year because of some of the tariff inflation uncertainties. Well, that's a whole nother can of worms that would obviously be negative for markets. So what you're seeing today is a risk-off sell-off. The MTUM ETF is down 1.64% today. A lot of other risk-off stocks or risk-on stocks like Tesla and some of your momentum names are also down a lot more than that. You can see XLP today, this is the consumer staples ETF, is only down 0.64%, and something like the RSP is down about 0.5%. So some areas are doing better than others today, especially, everything besides big tech. Like big tech is getting washed today. Apple's down 1%, Meta's down almost 4%, Amazon's down 1.5%, Nvidia's down 2.5%, Google's down 3%, Microsoft down 1.5%. Big tech continues to be an area that's getting sold. So at 2 p.m. Eastern Standard Time tomorrow, you're going to get the Fed interest rate decision. Now, we're not expecting the Fed's going to cut rates, raise rates, anything like that. They're not going to change their policy tomorrow. Okay, there's a 0% chance of that. So if you're betting on that, that's a bad bet. They're not going to do anything tomorrow. But at 2 p.m., you will also get the summary of economic projections. Now, the summary of economic projections looks like this. You get, let me zoom in a little bit here. You get the median forecasts. You actually get the range over here, like the highs, the lowest. What people really care about is the median here. So you get the median target for GDP this year, next year, and 2027. You get the unemployment rate as well, PCE inflation on the headline, core PCE inflation targets, and the federal funds rate projections. And again, what's really going to move the markets is this. And what changes do we get? So I can show you the changes that we got from the last SEP, which I believe was in September, until the latest one, which was December 18th. So the change from those two SEPs, December 18th, obviously on the S&P was a really bad day. Markets were down 3%. And a lot of that selling, really all of that selling happened in the last 2 hours or so of the trading day. As soon as the new SEP came out, it was a bloodbath for markets, to say the least. Okay. And what happened was The Fed actually raised their GDP estimates, okay, for 2024 and 2025, right? We're no longer in 2024, so keep that in mind, clearly. Their unemployment rate, they projected that lower for 2025 from 4.4% down to 4.3%. They raised their inflation estimates on the headline PCE from 2.1% to 2.5%. And they raised core PCE targets from 2.2% to 2.5%. But they also raised their projections for where the federal funds rate would be by the end of 2025. Essentially, instead of pricing in 3 to 4 cuts, the Fed came down to pricing in 1 to 2 cuts. And that's what really caused markets to sell off. Question is, do we keep the same 3.9% target for the end of this year? Does the Fed lower that? Do they raise that higher, indicating less cuts? I think it's a toss-up, right? It'll tell us if the Fed is more concerned about the economy or about inflation. Okay, if they move their target up, meaning they're, expecting federal funds rate to be, let's say, 4.2% by the end of the year. That means they're less concerned about the economy, more concerned about inflation. If they lower this back down to like 3.5% by the end of 2025, they're more concerned about the economy. And to be honest, I don't know what's going to move markets more. If the Fed is worried about a recession, I don't know if that's good or bad relative to the Fed worried about inflation, right? You could make an argument that they're both just bad. So again, the best case scenario is probably not much of a change here. Now, obviously, if they revise PCE inflation targets lower, that would be a good thing. I don't think that's going to happen. I think they roughly stay the same. Now, the unemployment rate, that's going to be interesting because by the end of 2025, they were projecting 4.3%. There's a lot of changes, though, on immigration, deportation, and you're really not seeing those immigration levels coming in. So that could help to raise the unemployment rate, which could make the Fed a little bit nervous. And I think the unemployment rate projection is a bit of a wild card for the SEP coming out tomorrow. And GDP is also a wild card. So we kind of already know the Fed's going to keep inflation targets high. Federal funds rate's a bit of a wild card as well. Again, what do they care more about, preventing a recession or, continuing to put pressure on inflation? But the GDP targets are going to be really interesting because currently the Atlanta Fed GDP Now tracker, and we got a new update today, is coming in at negative 1.8%. Okay, you're severely negative for Q1. But the Fed's 2025 target for GDP is 2.1%. Does the data that we've got so far in this quarter, Q1, lower their targets for full year GDP? Okay, let's say full year GDP comes down to like 1.5 or 1%. That's a pretty big change. Now, if GDP comes down theoretically to like, let's say 1%, but the Fed also prices in less cuts, then that's kind of a stagflationary environment. I don't think the markets are going to like that either. So it's not just one component of this SEP that's important. It's really the combination of all of these. And what does the narrative say? Now, I don't think, again, PCE is going to be revised up. I think the Fed's going to just keep that where it is. If it is revised up, that's obviously a problem. But it's really the unemployment rate, GDP, and where the Fed thinks their federal funds rate will be by the end of this year. Any changes to those, I think, could be large. I think GDP could come in way lower. I think federal funds rates might actually not move. So less growth with less cuts potentially could be the outcome of tomorrow, which I don't think would be positive. And I think that's why you are seeing this pre-anticipatory Powell sell-off in momentum, in growth, in high beta. That's what you're seeing today. So I think that's actually what's driving the markets versus some of the data that we got out today. Now, what's also going to be important tomorrow is the actual speech from Powell, because yes, the summary of economic projections is going to tell us a lot, and markets are going to probably move a lot off of that at 2 p.m. But Powell comes out at 2:30 p.m. tomorrow, and he's going to get asked a lot of hard questions about the Atlanta Fed GDP. I would hope he's asked about the negative 1.8% reading for Q1 GDP. He's going to be asked probably openly about, does the Fed think a recession's coming this year? He's going to be asked some very difficult questions. And Wall Street hangs on to every little word Powell says during that conference. So we're going to get that initial statement out at 2 p.m. Once Powell gets on the conference podium, he's going to read that speech. Markets tend to move up when Powell reads that speech. But it's the questions, the unscripted questions, that actually move markets the most. Now, in a weird way, I think if we were to see another, let's say 3% day tomorrow to the downside like we had December 18th, that may be enough to spike the VIX and get you a more meaningful low on markets. Now, is that the ultimate low? I think that depends, again, whether we go into a recession or not. But again, if we were to fall roughly 3% tomorrow, something like December 18th, which again, I don't know if that's going to happen, that would be a peak to trough decline in the S&P of over 11%. If the VIX were to spike and you see a bit of a capitulation moment, I would feel more comfortable calling a bottom. But like I've said on this channel for a while now, I don't think you get an actual bottom in markets until you get fear in the VIX. That has not happened yet. Once the VIX is above 30, then we can talk about fear, okay? Not this slow and steady rise. That just really means people are starting to hedge portfolios. They're not really rushing in. Once you see a big spike and people are rushing into the VIX, once people are rushing into bonds as protection, that's a more meaningful bottom, okay? Could that process start tomorrow? It is very possible. Again, there's a saying on Wall Street. Wall Street will stop panicking when policymakers start panicking. Do we get a bit of a recession panic from Powell tomorrow? Could that be the kind of final bit of bad news we need? It's possible. I definitely wouldn't rule it out. And I do think, unfortunately, the risks for tomorrow are skewed to the downside because, again, the Fed's not going to be able to raise GDP estimates in their summary of economic projections. They're probably going to have to slash those dramatically coming tomorrow. They're probably going to raise their unemployment estimates because of the dynamics that we have right now. I don't think with tracking negative 1.8% GDP, the Fed can confidently say that unemployment's going to, not go up, right? Unemployment's obviously going to go up, and they're probably not going to be able to lower inflation expectations. What do they do with their federal funds rate? Are they, again, concerned about a recession or are they concerned about inflation? It kind of seems like it could be a stagflationary kind of SEP tomorrow. And that's like the worst possible scenario where you have stagnating growth and higher inflation that doesn't allow the Fed to cut. It doesn't allow the Fed to, boost the economy when maybe you're like potentially borderline recession. We'll have to see. It'll also be important to see what the Fed does for their longer run neutral rate. In the September SEP, they had 2.9% for the longer run neutral rate. That's where the Fed would stop cutting rates. That's where essentially the Fed believes their federal funds rate is neither restrictive nor accommodative to the economy. Well, in December, that was revised up to 3%. Does it get revised up again? We'll have to see, because this was ultimately something December 18th that I think helped send markets lower 3% that day. It was kind of quiet at first. Nobody was talking about it. And then everyone was like, oh, wait, the Fed's revising their long run neutral rate forecast. That's not good. Now, also in the news today, Trump and Putin had an hour-and-a-half long conversation where they discussed peace and ceasefire in Ukraine. They agreed to start with energy and infrastructure ceasefires. Technical negotiations underway for Black Sea maritime ceasefire as well. As you can see today, the S&P is down about 1.2%. It really is kind of played out for the markets. We already had that peace boost, which is kind of part of the reason why markets bounced in the first place. And those headlines just are not hitting the same. They're not getting everyone excited like they were at first. The White House says future with an improved bilateral relationship between the United States and Russia has huge upside. This includes enormous economic deals. Putin reaffirms commitment to peaceful resolution, discusses Middle East and energy with Trump, Russia, U.S. to form expert groups on Ukraine's settlement, Moscow to hand over 23 wounded Ukrainian servicemen. Putin agrees to a 30-day halt on energy strikes and calls for a stop to Ukrainian mobilization and arming. Trump supports Putin's proposal for U.S.-Russia ice hockey game. You also got today the GTC keynote from NVIDIA. This is the GPU conference that NVIDIA now famously holds every year. So far, we haven't gotten much out of this. You haven't seen much of a reaction. But we'll be on the lookout for any headlines that come out. It looks like NVIDIA stock actually sold off once Jensen started to speak. NVIDIA down today about 2.5%. Other big tech names are also down a lot. Microsoft down 1.5%. Google's down 3%. Amazon's down almost 2%. Meta's down 4%. Apple's down almost 1%. It's kind of surprising the S&P is only down 1.15%, all things considered. You could see XLP also down. This is the consumer staples ETF. Not down as much though, only down 0.62%. Momentum, the Momentum ETF here, MTUM, is down 1.66% today. So definitely a little bit more pressure in that area. And if we look at the equal weight S&P, you're only down 0.5%. So big tech continues to take it on the chin today. QQQ has to be the underperforming index, down 1.7% today. And really, you've given up a lot of the bounce that we've seen so far, especially for the QQQ. The QQQ, the NASDAQ 100, if you will, is down 12.3% from the highs. But again, you were down almost 14% at one point. I mean, you're kind of near the lows of this correction yet again after that 2-day bounce. Also in the news today, the U.S. housing starts soared. In February 2025, U.S. housing starts increased significantly by 11.2% month over month, reaching an annual rate of 1.501 million units, surpassing the expected 1.38 million. This surge was primarily driven by an 11.4% rise in single-family home starts. However, building permits saw a slight decline of 1.2%, totaling 1.456 million, which was marginally better than expected. Housing completions also dropped by 4% to 1.592 million. Despite the immediate boost in construction activity, the decrease in permits and completions indicates a potential future slowdown in the housing market. This mixed data suggests a robust current market activity, but hints at cautious future growth. And that's kind of the best way to sum up the data that we got today. And could also be a reason why markets are under pressure, because more of this wealth effect could be starting to reverse. Now, on the upside, as markets have ripped higher in recent years, I mean, people have felt pretty good, and that's one reason why maybe people were spending money. Home prices were going up, stocks were going up, pretty much everything was working. Now, stocks are basically in a correction. If you're in the NASDAQ, you're in a correction. If you're in average stocks, you're in a correction. S&P is pretty close to a correction. Home prices are stalling out, and activity overall is really stalled out. I mean, the wealth effect is essentially the higher asset prices go, the more comfortable, the more spending people tend to do. Now, the sad fact of the reality is, in this economy, 50% of all dollars spent in the economy are coming from the top 10 wealthiest people. So, you know, this is up from 25 or 30% of all dollars spent by the top 10 wealthiest people 10 years ago. I mean, there's a dramatic shift between lower income consumers, average people spending less, and higher income earners spending more, that you could argue has been the reason why we've remained out of recession. The asset price inflation we've seen, stocks going up, home prices going up, could have been a driving factor of that spending by the highest income earners. If that starts to kind of go away and asset prices start to fall, then you can make an argument that maybe spending will start to fall by 50% of the dollars spent in the economy, right? You could make an argument that maybe that percentage starts to fall, and that would not be good for keeping us out of a recession. You can also see today in February 2025, U.S. industrial production significantly outperformed expectations by increasing 0.7% month over month against a forecast of 0.2%. This surge was primarily driven by a 0.90% rise in manufacturing, with the auto sector leading with an initial 8.5% increase in output. Other sectors like mining also saw gains, while utilities experienced a decline. The capacity utilization rate rose to 78.2%, indicating a robust economic activity level. This unexpected growth challenges previous recessionary fears and suggests a strong economic recovery, particularly highlighting the revival of the Made in America manufacturing ethos. I think a lot of that just probably has to do with tariffs initially being put on, because what tariffs are really doing, let's say you own a company that makes aluminum cans, for an example, is probably the easiest way to put it. Let's say that you own this company that makes cans, okay? Well, now aluminum has a tariff on it. If you previously got your aluminum that was cheaper through Canada, now you might be saying, well, instead of paying the tariff, I'll go through a manufacturer in the US that's a little bit more expensive to avoid that tariff. Okay? So you're still going to be paying more potentially, but maybe not as much as what the tariff would be. So it's really incentivizing American companies to buy from other American companies. But again, that could still hurt margins. And that initial kind of changing of distribution, if you will, is probably what you've seen in the data today. I would be hard-pressed to say that lasts a long time, okay? Because there's only going to be so much changing that happens so fast. We also have some pretty important earnings as well. You do have Five Below tomorrow in after hours. You have General Mills tomorrow pre-market. But Thursday, you have Micron, Nike, and FedEx in after hours on Thursday. Those are going to be really important. I mean, you have AI with Micron, Nike, consumer discretionary, and FedEx really kind of economically important. Okay, so these three companies actually are going to be more important than you'd think. And there's a saying on Wall Street, the stock market does not stop panicking until policymakers start to panic. So believe it or not, if Powell does sound a little bit nervous about a recession, then sure, that could give markets a little bit more downside. But if Powell's suggesting perhaps tomorrow that they could cut rates more than expected this year, that may actually be a positive for broader markets. What's also interesting today is TLT. TLT is the ETF for the 20-year Treasury. It kind of tracks the 10-year Treasury as well. This is the most popular ETF for Treasuries. And when Treasuries are going up, when they're green on the day, that actually means yields are falling. So Treasuries were pretty red today. And then you've kind of started to come back towards the end of the day. I think this is some people getting ready for Powell tomorrow. And this signals that maybe you get a Powell that's a little bit more prone to cutting rates. Again, when you look at the broader indexes today, the Dow is down 0.6%, S&P is down about 1%, NASDAQ down 1.58%, Russell 2000, one of the better performing indexes, but also the hardest hit index at this point during this correction, down 0.87%. The VIX is up 5.76%. Now, I warned about this before here on the channel because you have not gotten that huge volatility spike. What has actually happened with the VIX is you have fallen from a high of 29.56 down to 21.67. So the fear has actually subsided a little bit, but look at the S&P. You're still sitting near the lows. So you could theoretically hit new lows here without the VIX hitting a new high, which to me looks like you're more vulnerable at this point to downside than for a reversal to the upside. CNN's Fear and Greed Index today is coming in at 20, if my numbers are correct here, which is down a little bit from yesterday. Yesterday, you were at 22. All of your categories are in extreme fear besides market volatility, which measures the VIX and its 50-day moving average. That's coming in neutral, and junk bond demand currently in greed. You can also see the percent of stocks trading above their 50-day moving average, down almost 2% today to 28.73%. So again, same story. Markets internally are still pretty weak. Let me know what you think about all of this information down below in the comments section. Have a fantastic rest of your day, and I will see you in the next one.